this is Matt Hunnicutt, practicing partner here at Eagle Wealth with our October 2022 market update. I'm here to talk about some of the recent economic headlines and give you some insight into what they could mean to you as an investor. The pace of economic growth has been slowing this year. Policymakers are telling the same story. The Fed will do what it takes to get inflation down, even if it triggers a recession. That's not much of a surprise, since 2021 had the fastest yearly pace of growth in about 40 years. And many of the tailwinds that supported that growth, like federal government stimulus and debt refinancing due to low interest rates, are no longer available. Added to that are the higher levels of inflation that have taken away purchasing power, and the Fed, which has been aggressively raising interest rates to discourage spending and try and drop inflation. The Fed is front and center of the discussion regarding the future direction and pace of economic growth. The underlying economy is doing okay once volatility in the data from the pandemic is stripped away. The unemployment rate is falling, wages are increasing, and spending continues to grow. The economy is probably growing between 1 and 2%, slightly below the 2.25% it averaged during the past 10 years of expansion. But now, entering center stage are Chairman Powell and the Federal Reserve Bank. They remain resolved to do what is necessary to bring inflation back to its target rate of 2%. In March, they started raising interest rates from the near zero level. This summer, they pushed the overnight Fed funds rate above the neutral level. That's the hypothetical Goldilocks rate that neither stimulates nor constricts economic growth. Below that level is stimulative, above that level is restrictive. They plan on raising it further into the restrictive territory with rate increases of 75 basis points in November, 50 basis points in December, and then another 50 basis points in 2023. The Fed's planned pace of tightening is the fastest since 1980, when Chairman Volcker raised interest rates from 10% to 20% to combat inflation, which peaked at 14.8%. Today's Fed needs to be aggressive. Their actions today have had minimal impact on inflation, but it's starting to impact behavioral change, which is the first step in bringing down inflation. The most interest rate sensitive sector of the economy is housing, and in time-honored fashion, the housing sector is falling victim to the Fed's actions. Mortgage rates are now above 7%, well above the 3% of a year ago. The monthly mortgage cost for a median-priced home has surged to $1,858. 2 years ago, it was $1,060. The higher interest rates will start moving into other areas of the economy, like auto loans, which are currently at 5.8%. A year ago, they were at 3.9%. This is the early stage of the Fed's quest to bring down inflation. How long it will take is the $64,000 question. At some point, households will become fearful of a recession and job cuts, and as a result, they're going to reduce spending and increase savings, slowing the pace of economic growth and reducing the inflation rate. At least that's what the Fed is hoping for. That's what they call a soft landing. But if that doesn't do the trick, the Fed will continue to raise interest rates, which will inevitably cause job losses in a recession. How this plays out is still unknown, since the trajectories of change in consumer behavior are nearly impossible to model. Let's take a look at what's driving markets right now. Investors have had little place to hide in 2022, as both equity and fixed income markets have simultaneously recorded 3 consecutive negative quarters for the first time in over 4 decades. Unfortunately, volatility looks set to continue in the near term, with the persistence of inflation providing an unwelcome reminder to markets that rates may stay high for longer than anticipated. Until we see a pattern of lower inflation readings, equities are likely going to have a hard time mounting a sustainable rebound, and bonds could remain under pressure as well. In the labor market, demand for workers remains strong, but the pace of hiring is slowing. This is what the Fed wants to help reduce the rapid wage growth, which is also keeping inflation high. Pricing pressures remain stubbornly high at 8.2%. Fed policymakers remain diligent in their plans to raise interest rates to help combat high inflation. The Fed expects to hike 125 basis points more before this year is out. The red hot housing market has slowed significantly due to mortgage rates above 7%. They were around 3% last year. Lumber prices have almost returned to their pre-pandemic level. During the recent housing boom, they were more than quadrupled in price. After falling 135 cents this summer, gasoline prices are starting to increase again due to fears that a reduced oil supply is looming from OPEC constrictions. The headlines haven't skipped a beat in reporting about these market trends, but they don't paint the whole picture. They're just trying to get your attention. Now, it's easy to focus on the negative when the future looks uncertain and grim. We as humans are just wired that way. We tend to skip right over the positive and focus on the negative. Now, I don't have a crystal ball to tell you what the economy or the markets will do next. I can't tell you whether we're in a recession yet or whether one is coming. I can tell you that we have a very resilient economy. The jobs market still looks really healthy, and investors are poised for optimism if inflation and interest rate hikes stabilize. I can also tell you that the last quarter of the year has historically been a strong period for stocks. The bottom line is this: we can't control macro environment, but we can control our own actions and reactions. We can approach an uncertain future with prudence, flexibility, and wisdom. Looking ahead, we're expecting significant volatility through the rest of the year as investors digest inflation and economic data, the Federal Reserve moves, and the midterm elections coming up in November. Now, we're watching, we're judging the conditions, and always we're looking out for your best interest. As always, please reach out to us if you have any questions. We're here to help.